Good evening, traders and investors. I'm working on an article, and I'll probably turn it into a video as well, about trading versus gambling. I listened to a good podcast by Brian McAvoy the other day, and he was talking about, a lot of people are putting on these trades, but really, the trades they're putting on are really just gambles. They don't have a true strategy. They're discretionary traders, kind of swinging from the hips. And this is true even for highly skilled traders who've done this for a long time. It's easy to fall into, it's more of a gamble than a trade. And that's what I always try and show with our trades is there needs to be rules. There needs to be a reason why we're getting in, a reason, and have levels of where we're getting out and our targets all measured. It has to make sense. It shouldn't just be some random trade because something's moving. And so I'm going to do an article on that, talking about the difference between a trade and a bet or a gamble. And they are different. I think a lot of people trade just to satisfy that gambling itch, because there's no doubt trading is fun. It's an adrenaline rush, but those usually cost you money in the long run. But anyway, I also want to just mention, if there's something different or that I could do to these videos to make them easier to understand, let me know. Maybe bigger font, bigger charts, maybe lingo I'm using. Give me some insight if there's anything you think I could do to make these just cleaner, simpler for you to follow, or maybe something I don't need to cover all the time, or something I do need to cover. Just share any insight. I want to try and save everybody time and just get to the nitty gritty of things here. So let's just jump into the charts. There's some interesting things going on here. If we go and take a look at, let's take a look at price spikes. The SPY, we talked about this the other day in a video. And price spikes are this kind of really weird spike that happens on the SPY ETF. It also happens on the QQQ. It happens usually before 9:30, usually around 8 o'clock. You get this big spike down. And if I was just to zoom in a little bit, I have it set so that a third of the spike distance, there's a line halfway, and then 100% measured move. And usually the spike happens, and then as the market unfolds through the day, it comes down and hits at least one of those levels. And so you can see we've had multiple sets of these spikes. We had one spike to the downside. This was like 5 days ago, and the price came down, hit 1, 2 levels. We had a spike up a few days ago. Price rallied up, hit all three, and kept on going. We had another one this morning, which if we take a look here, is a big spike this morning. Price didn't quite make it up, got darn close, but definitely didn't quite get there. It looked like the market was ready to keep pushing higher. Instead, we hit another bout of selling on the SPY, and we bounced. I'm not sure. Let's just take a look at the QQQ out of curiosity. We saw a little bit more strength in the QQQ, where it didn't make a lower low later in the day. But we can see the market, it had this exhaustion gap down we talked about. This is across the board. All the indices gap lower this morning. Usually gaps to the downside after a multi-wave run and a little bout of broad market kind of FOMO. Usually this can turn into a bottoming level. Now you can see the market dipped into a couple of these lime green oversold conditions. Usually after an oversold condition, we tend to see the market rally up. You can see we have an oversold condition here, and we go into a rally. And then of course, when we look at the price action, it's been bouncing up the pink line, the 20-day moving average. We're coming down close to that. The SPY doing the same thing, up the 20-day moving average. And again, we're testing that level. There's elevated volume today, so there's definitely an emotional turning point unfolding where it's getting oversold. People are panicking. This could be an exhaustion little island pattern, meaning it gaps down, and then it creates a little island of trading bars, and then eventually we see the market shoot higher and start to run. So the market's just trying to shake things up. It's trying to get people out of the market. And we did see on a shorter term time frame, we saw panic selling this morning right down near the low. And when we have panic selling, usually we see the market put in a bottom and bounce on the short-term chart. So lots of interesting things unfolding there. Now, the most interesting thing is one of you wanted to look at what GDX did in 2007 to compare these charts. Now, if you've been following me for a while, you're probably starting to get tired of this chart, but here's a new spin on it. So this side on the left is the 2007 S&P 500 rally to all-time highs, and how gold rallied with the stock market, telling us that, hey, yes, the stock market's going up, but people are moving into gold as a defensive play. They think something's wrong. That's where we are now. Stocks and gold ripping higher, both at all-time highs. Now, what's really interesting here is if we start to look at what gold miners did during this time. So let me just segregate all of these really quick. There we go. All right, let's see if everybody can keep up here. There's a lot of lines on this chart. Let's just look at 2007 on the left-hand side. The top is the S&P 500 hitting all-time highs just before the 2007 market peak. The yellow line is gold, pushing up, rallying with stocks. The blue line, GDX, didn't quite go back all the way back, but it doesn't matter. The key is GDX was more so trading sideways, a lot like gold was for a while here. And then suddenly gold miners kind of broke out and they started to shoot higher. And then, of course, we had the dollar falling down to some lows. Now, all of this is very similar to where we are right now. We've seen gold more so. It did have a little bit of a pause sideways. It's pushing up to all-time highs. Miners have, they've traded somewhat sideways for a while. They have been slowly making gains, but really recently they've really exploded to the upside, just like they did over here as the stock market was hitting an all-time high. Now take a look what happens as we move forward. The stock market starts to top out. Gold and gold miners continue to rally until they peaked out. So I'm just going to move forward so we can see these numbers. Now the stock market fell it actually fell about 20%. Gold rallied 32% from that peak, and gold miners rallied 18%. And this is why I've been telling people, to me, the play is physical gold. There's a reason why we're in physical gold or the physical gold ETF, and both in the case that I have both of those positions on as well, is not only because it's a more stable move, but it also has proven to be a global defensive play, meaning the whole world buys into gold versus more just speculative traders moving into miners in this stage. It is a much more roller coaster ride, about half of the upside potential as what gold could have. When the whole world gets nervous, they're going to buy gold. But when the whole world gets nervous, it doesn't mean they're going to jump into, fast-moving gold stocks. It's really more so gold bugs and people who are honed in on that want to get into them, but it's actually not always the better play. And so when we go to where we are right now, we're at a point here where gold miners could have a little bit of a pause or pullback, and they have upside potential. But gold is the one I think that will perform better before the market goes and sells off, and then eventually. If we just go to this whole stock market sell-off, the stock market fell 55%. If you take a look, gold fell about 34%. This doesn't show the spikes, but it fell from the peak about 34%. And gold miners fell like 65+% as well. So you have a lot less upside and more downside risk if the market is to start to go off a cliff here. And the other thing, obviously, is we go back in time here. We have the U.S. dollar. The U.S. dollar eventually starts to put in a bottom as the stock market really starts to collapse and everything falls in price. The U.S. dollar put in a huge rally, put in about a 20% move to the upside. So that's kind of the scenario where we're at. We're just seeing gold stocks pop. People are moving into gold stocks right now as the leverage play. How can I make more out of the precious metal move? And at this point forward, there actually may be still more potential in gold. That's kind of the same scenario. We're kind of like where right here is kind of where I think we are, which is right here. So yes, there's upside, I think, still across the board. Which one has the least amount of risk? Which one has the most upside potential? And believe it or not, gold does. It's usually the opposite of what the masses think. And I believe the masses are moving into miners right now. Whoever's going to get into the precious metal space, they're moving into miners because they want to make more. And it's usually kind of what they don't expect to move is the one that has the larger upside potential. Again, gold is more of a global play, the whole world moving in, versus miners is more so traders moving in, which is a much smaller pocket than the whole world of investors. So with that said, if the dollar was to rally, somebody shared an interesting video with me, which I haven't fully watched it, but talking about what the administration is looking to do and how potentially inflation could take off and how interest rates could go up substantially, which is kind of funny because this is what I've been talking about for a while. And every time I bring this up, everybody loves to jump down my throat, and that is perfectly fine. That usually means it's actually a good thing. But if we just look at the monthly chart, of the interest rates. Let's go way back. So we go way back, 40-year cycle, falling interest rates. Well, now they've put in this giant bull flag pattern, and potentially what's happening, and we could see inflation take off. We could see quantitative easing. Who knows? We could see all kinds of stuff. But we could see this big move. And I've been talking about how we could see 8% interest rates, which nobody's really expecting or planning on. And of course, the markets tend to do what you least expect. And of course, this will eventually hurt gold. So I think gold and the precious metal space are in their sweet spot. They're on their big run. We have to be aware that we could see interest rates shoot higher. This will annihilate the real estate market. The bond market will collapse. I've talked about how you do not want to pick a bottom. If this does happen, bonds are going to get absolutely annihilated and continue to fall like TLT. This is why we don't want to pick tops or bottoms. We let trends mature and we get in. And so it's really, what else is interesting is if we look at if you're a Canadian investor, if we look at the chart here, we've seen the US dollar strengthen dramatically over the past over the past several months. It's moved up very nicely. As we know, my view on this is from a Canadian currency standpoint. If we just go way back in time, we have this, I think I got to change time frame. I'll go to a weekly here. We have this massive chart pattern unfolding, and we can do a Fibonacci extension, which points to a pretty significant move. Actually, the one thing I should point to is we did see in 2008, the US dollar took off and it rallied 20%. And for a Canadian, if we were to move into the US dollar, it's a 30% move in the currency swing, meaning we move to US dollars, it rallies 30%, and then eventually we can move back into the Canadian dollar, and the US dollar will fall and our Canadian dollar will shoot higher in value. So we get to make these big currency moves that happen. These are very rare, but they do happen. So there was a 30% move going into a similar-ish situation when you just look at price action, not so much the economic and political environment, but there's lots of that upside potential. Now, if we look at Fibonacci extensions and we go from this low up to these highs up here and down to these lows, it's going to project forward where we could see this upside move. And I've shared this before, and it is a pretty extreme level. This is talking about a $1.73 exchange. And just based on that move from where we are, that is a roughly 24% move. If the economy eventually goes into haywire, potentially interest rates skyrocket, and we see the dollar take off and other countries crumble, the Canadian dollar and the economy, everything crumbles. So, holding the US dollar becomes a strong play, which goes against the grain because everybody thinks the US dollar is going to be worthless, and it is a fiat currency and it goes through its cycles and should eventually become worthless. But just because we know it will probably at some day doesn't mean it's going to happen right now. And of course, I remember people talking about the dollar being worthless back in 2008, 2007, and every year, more or less. There's websites just on the collapse of the dollar, but it doesn't collapse quite that easy. Anyway, there's huge upside potential in this move. So, this is good for international traders who want to move from currency to currency. I still think the US dollar right now is trying to carve out a bottom. It's carved out a bottom in terms of the Canadian dollar. It started to break out today. This week, if we go back to the daily chart. And so I really like what's unfolding here. This looks like a very nice bottom, and I think we're going to see a significant run to the upside just holding US dollars going forward. And of course, as I mentioned the other day, we talked about real estate, talked about the REITs and how they can become a very, very lucrative opportunity going forward. And of course, if this was to happen, if we were to see interest rates skyrocket, it is going to probably crush the real estate space. And I think we could see the REITs have a precipitous waterfall. And everybody who thinks real estate is the best thing since sliced bread, and I know people who don't understand the real estate market and the financial and economic cycles. They're still looking to buy homes right now as an investment property, which to me makes no sense because the numbers don't even make sense. And if the economy gets weaker, you're going to eventually get lower rates, which means the numbers don't work anymore, like lower mortgage or rental rates. Anyway, I think we could see this huge collapse and have an opportunity to buy into real estate that's paying. These purple lines across the bottom are dividend payments. So every month you're getting paid, dividend payment. And as we know, real estate is consistent and it does very well. So anyways, that's really it in a nutshell. Let's recap what the charts are doing today. Let's look at a couple other asset classes real quick. So if we look at the dollar today, the US dollar index itself has popped and is really pushing firmly to the upside. We did see gold, silver, and miners all move up with the dollar. And this is totally normal. We can see gold and the dollar move up together for short windows of time. There can be, it's just the way it works. Just because you think they have an inverse relationship, and they usually do, doesn't mean they always do. Things change. There's very unique situations where they can move together in sync. If we take a look at silver, it had a really nice gain today, up 3%, really extending and pushing to the upside. Gold miners had a pretty nice pop today, well, only up about 1% or so, but trying to find some traction to move higher. And if we take a look over at crude oil, crude continues to hold its ground in this kind of longer pattern, kind of bearish phase. We got this big move down, a big sloppy sideways kind of move. Bear flag, we got another move down, we've got another kind of big flag. It is still looking kind of like it wants to work itself down, but again, there's no real clear insight in the energy space, so we're not really going to be focusing on that. And energy stocks actually were one of the sectors that closed stronger today. Oil moving up, energy stocks pushing higher. I'm not exactly sure why so much. It could still be the news about supply, and now maybe these energy companies can get more profit out of it. But I do think there's going to be a very big decline eventually in oil and energy stocks, as we've talked about, and an inverse ETF trade on this sector at some point down the road. Last but not least, let's take a quick look at Bitcoin. This is the IBIT. Moving down over 3.5% today. We'll look at actual Bitcoin futures here, but pretty much the same type of price action. Again, Bitcoin just not finding the love. It definitely feels disconnected. It does not feel like a defensive play. It doesn't feel like digital gold. It really just feels kind of dead right now. And so it needs to work itself out. And there is potential for it to still have a nice push up to 136,000. That is our next upside target. But overall, I'm not a big fan of kind of what's unfolding. I think we're kind of in this stage. I think it might get a little uglier and work itself out and try and really cleanse it before maybe it wants to go higher. Anyways, that's it for now. Take care. Bye-bye.